Good morning, everyone. Welcome to the investor panel. I think it's always the most exciting panel of the conference. We're going to hear from the guys who, put their money where their mouth is and write the checks. So I've got the pleasure of doing the interrogations today. We've got a fantastic panel. As Sasha already introduced me, so I'm with Jones Lang LaSalle Hotels and Hospitality Group, looking after transactions and advisory in sub-Saharan Africa. Then on my left, we've got Othman Jabri, who's with Kingdom Hotel Investments, based out of the UAE and Saudi. We've got Alex Smertnik from Quantum Global, based generally between, I think, Mauritius, London, Paris, and a few other places. And we have Alexis Janorai, who's from Accor Hotels. So a good panel to start. We've got about 30 minutes, so we're going to jump straight into it. We'll have some time at the end for some questions. Maybe I can start with you, Othman, and work our way down. But can you give a quick snapshot of what you're doing in terms of hotel investment or divestment on the continent?
Good morning, everyone. For those who are not familiar with who Kingdom Hotel Investment is, basically Kingdom is the investment arm of the Kingdom Holding Company, chaired by His Royal Highness Prince Walid bin Talal. We basically handle all his investments in the hospitality industry. We have exposure to the hotel industry via investments in management companies. We are shareholders of 3 leading management companies, being Fairmont Raffles Swiss Hotel, Movenpick, and Four Seasons. We own the real estate of about 18 hotels in 13 countries, out of which about 6 are in Africa at the moment. At our best, we were at about 10 hotels in Africa in total. So we basically started divesting from the real estate in the emerging market about 6 years ago, and we've disposed of 5 hotels in Africa in total.
Great. So generally speaking, in Africa, selling, not buying at this stage.
Correct.
Okay, great.
We still have about 5 hotels to sell in Africa.
Great. Alex, same question. Bit of an overview of what Quantum is doing in terms of your investment strategy for Africa.
Sure. So good morning to all. I'll do like Othman and give a quick snapshot of who Quantum are and what we're looking to do in sub-Saharan Africa. Quantum Global is a firm based out of Switzerland, but with also offices in Mauritius, and I do spend a bit of time in London. More recently, we've raised several funds, and one of them being specifically for targeting hospitality, the hospitality sector. And this fund is roughly $500 million in size, and is targeting hospitality assets across the sub-Saharan region, whether it's West Africa, East Africa, or more the southern regions. And what we're looking to do, in a nutshell, is purchase or brownfield, greenfield, as well as existing assets that give us the exposure to the hospitality industry. And whether it's 3-star all the way up to 5-star. We don't tend to look at resort destinations or resort hotels. It's just not part of our, of the strategy. And while the fund has been around for, has been fully raised since a year ago, and one of our first transactions occurred earlier this year with the acquisition of the Intercontinental in Lusaka.
Okay, great, thanks. And it's so just to clarify, you're a PE style fund with a set investment fund period, or how does it work for you?
Yeah, so the way the fund is structured, it is a PE style fund with a longer term than most traditional funds. This is also to cater to the specificities of the African market, where, the liquidity is not as preeminent as North American or European markets. That's why, just to give you a few of the characteristics, we have an investment period of 5 years with 2-year potential extension period, and the total holding period is if I remember correctly, 10 to 12 years with further extension periods. So again, quite a long-term PE fund, if I may say, which I think is quite important in order to reap the opportunities in the continent.
Okay, great. Alexis, you're talking on behalf of Accor. Accor has got Accor Hotels, Accor Hotel Invest. So you're looking both at operating investment and investing. Do you want to give us a bit of flavor as to what you're looking to do in the region?
Yes, of course. Good morning, everyone. So as Xander underlines, I think what makes the specificity of Accor Hotel is that we are a hotel firm, but we really have two different but very complementary business models. One being a hotel investor via Hotel Invest, and the other one being a standard classical management company via hotel services. So just to give you a rough overview, today Accor Hotel is nearly 4,000 hotels in the world, and 1/3 are being owned directly. That's the case also in Africa, where we own 12 assets in sub-Saharan Africa. We own nearly 30 assets in Morocco, several in Algeria via joint ventures. So that's pretty much a rough idea of what Accor does in Africa. I think what is interesting is that we are clear leader on all these markets. So I'll get back to that point later on, but I think it's important to point out.
So invested in more than 40 assets in Africa. How do you make the decision between which asset you operate only, and when do you actually come in with your own equity?
I think there's three main decision criteria for Accor to decide to invest into a project. The project itself, but I think that's common to all of us, meaning that you want to benefit from good investment opportunities in immature markets, where there will be some upside, where there will be some growth. Of course, if you're in a market where there's a few brands and less competition, so that's the first criteria. But I think in addition to that, there's two very important criteria that we have within Accor Hotel. One being we need our investments to be a leverage for profitability, meaning that we need, of course, the investment. I mean, by investing ourselves into one asset, we actually benefit from the return that we get as an investor, but also as a management company, which means good leverage for Hotel Invest, good leverage for hotel services. And you can also, I think by doing that, benefit from a regional structure, meaning that you can also rely on the investment structure that could, to a certain extent, help you with your management. Third criteria that is really key, and I will spend a little bit of time on it, is our investment needs to fit into our development strategy, and actually our investment needs to be a leverage for development. Typically, if there's a strategic market that we would be willing to enter, investing can be the good way to do it in order to fasten your development. There's several advantages to that. You control the timing, of course, so you're not relying on opportunities that can be brought by investor. Of course, you control the development of your project, and we all know that projects in Africa can take a lot of time. Thirdly, you manage to enter the market with the right product at the right standards. So I think that to a certain extent, you're creating some kind of flagship that will help you and benefit your further development. I think Nairobi is a good example. We're about to confirm an important investment in Nairobi. It's a key strategic investment city for us, and of course by showing some commitment, we would definitely I think benefit from it for our future development, and also to be able to quickly set up local operations in support for the future management contracts that we'll be signing in East Africa.
Okay, great. It'd be good to hear a bit more about that transaction later. Othman, in Africa, certainly sub-Saharan Africa, assets tend to be fairly tightly held. You know, there's a lot of family capital in. There's a lot of generational play. I mean, you're one of the few investors who've invested in a fair size portfolio and are now exiting. How are you finding liquidity sort of at the end of your exit period?
Well, you're right in the sense that Kingdom has been investing in Africa when no one was looking at Africa about 10, 15 years ago. Today we've started implementing a strategy whereby we're selling our hotels. So our main focus is to find buyers who have the financial capabilities basically to take over the assets. In terms of liquidity, I mean, our view is that liquidity, I mean, there are lenders, there are people interested, there is strong interest in our hotels. There is a limited, the capital, if I can say that, the capital is limited. The interest is there, but the capital is limited. It depends on the geography, on the market, on the profile of the investor, on the opportunity itself. So it's a combination of various factors which sometimes tend to complicate an acquisition or development opportunity and put at risk the acquisition or development opportunity. In terms of I mean, Kingdom has been successful with the disposal of its assets. We've sold 4 hotels in Africa since the past 6 years. In Zambia, in Tanzania, in Kenya, we are on the market with another asset, the Movenpick in Ghana. The process this is going to probably be the largest open market transaction in Africa, which we're quite proud of. So again, from our perspective, there is liquidity, limited, but available.
Okay, great. And speaking of liquidity, clearly you recently announced the sale of the Intercom Lusaka to Alex on your left. So that's convenient that we have both parties up here. Alex, just looking at the Intercom Lusaka, can you give us a bit of an idea of how you viewed the asset, how you valued it, but I guess ultimately what your strategy was in buying it, and how are you going to take that investment forward?
Sure. So the rationale for purchasing this asset was not for its current, the current state of operations, but really for the potential that it offers. From the perspective of the location of the asset within the city, also from the perspective where we see the market currently versus what the prospective growth for Zambia in the next 5 years. So that was kind of the premise for looking into this asset. Also, when you look at the hotel, you roughly have 40% or even 50% of the available space which was not utilized, and we see that as a good opportunity to actually increase the room count, but also reposition the asset accordingly in order to tap into potentially the mid-market segment and keep thriving in the upscale, but potentially also the upper upscale segment. So where we see value there is buying the asset, but it's not worth buying the asset just to leave it as is. It will be very important to undertake a significant refurbishment and repositioning program, which we're actively working on now, and that we'd be hoping to launch within the next 6 months, I would say.
And do you find, in chasing PE-style returns, so to say, in a relatively tight market from a liquidity perspective, do you find that you generally have to add significant value through whether it's asset management, redevelopment, repositioning, like you're saying now?
Well, for this asset, it's definitely the case. It will be really important to reposition in order to increase EBITDA and increase refurbish the yield of the asset versus the total acquisition, but also the refurbishment investment. In terms of liquidity, again, we have a very long holding period for traditional PE fund, and we will not be pressed to sell at exit. We have various mechanisms that allows us to basically be more patient, and I think it's also the nature of our capital, which is again patient in nature. which will allow us to capitalize on the achieved growth and value creation at the opportune time and with the opportune buyer.
Okay, great. Alexis, you've as Accor Hotel Invest, you've invested in all across the spectrum from limited service budget all the way up to full service and beyond. What's your sense in Africa? Where you can get the best investment returns
Today.
today,
Or
exactly.
in the past. Today, I believe the best returns we would get are definitely on the mid-scale budget segment. Several reasons to that. I think that's the one that offers the best cash returns. It's lower investment in terms of quantum, so it's also lower risk. I think that's also where there's a real know-how for Accor, because I think we have a real expertise on these segments with with brands benefiting from a very good awareness. And last but not least, I believe this segment is also less volatile than the upscale segment. It's in case of first of all, they don't rely as much as on international travelers. I think the strength of a product like Ibis, for example, is to be able to target the local markets. So less volatile, and also in case of economical downturn, I think it's much more resilient in terms of business model. But I think what is important for us is to, and for you to understand here, is that the best returns are not only purely the are not purely the returns we will get on the investment itself. Because what we value, and I'm coming back to my previous point, meaning that investment is the leverage for development, which means that when we invest into a project, of course, we've got the return of the project, and that's something we will assess because we need to convince people internally of the opportunity to invest. But we also take into consideration the side effects and the side returns. So by investing, for example, I'm coming back to the example of Nairobi, but by investing in Nairobi, of course, we will have, and we're expecting some returns on the asset itself, but we're also expecting some returns in terms of our capacity to develop ourselves in East Africa and in Nairobi in particular more quickly.
So I suppose it's not a pure project return play. There's a broader, leveraging on your development strategy. So you're not just looking at the project returns, which is fairly unique, I suppose, to Accor, given your broader branding and operating strategy.
No, definitely. I think that's also what makes us different from a pure PE investor. That's another investment angle that we have, and that, of course, is linked to our business model. Yeah.
Okay. Just focusing a little bit on exit. We talk a lot about market entry, acquiring assets, but the wisdom is, of course, that you should never get into an investment that you can't get out of at some stage. You need some form of liquidity event at some stage. Othman, you've sold and you've exited in quite a few different markets, both in Africa and outside of Africa. What makes Africa different when it comes to exiting investments to, let's say, what you're currently exiting in North America or Asia?
Well, I'd say the scarcity of buyers. We've exited more easily in Asia. We've sold many hotels in Asia through ultra-high net worth individuals, family offices. The interest is stronger in that part of was at some stage stronger in that part of the world. In Africa, we've had to be flexible. We've tried several times to sell the hotels, several attempts, and at the same time we had to adjust our strategy. So each time we were going to the market with an asset, for instance, there was something happening, let's say in Kenya, which then affects the operation of the hotel, and obviously you had to retract the hotel from the market. So that we've had to be flexible. That was key. Our recent transactions are two most recent transactions were the Intercontinental Lusaka and the Mount Kenya Safari Club in Kenya. These were assets that we acquired back in 2005, 2006. We've held them for about 10 years. We've injected significant amount of money to refurbish them, to flag them with an international operator. We've asset managed them, and then we took them to market again after several attempts.
Okay, great. So I guess you have to be more flexible given a limited buyer pool. Alex, in terms of being in that limited buyer pool, you're looking for quality assets. You've got a fair pile of cash that you're sitting on that needs to go into good projects. I mean, how are you finding liquidity when it comes to finding good projects, finding good assets, and I guess linked to that is pricing. Do you think assets are being priced fairly in the market?
So, yeah, from our standpoint, what we've seen over the last 12 to 6 months is that, yes, there's been less capital available to invest in Africa on the back of the commodity situation, the fact that some of the high net worth that we're looking to invest, are not there anymore, and as you say, we still have that capital to deploy. So we've seen an increasing amount of good opportunities given the scarcity of buyers that come on our desk. I think the challenge also for us is to basically differentiate the good from the bad. But, when you have a pipeline, okay, it's great, you have like 50 assets on the pipeline, but in reality, when you look at the assets that are actually investable with while trying to limit the execution risk, you actually narrow down that that number of 50 assets to really 5 assets that could be truly investable within by the end of the year. So there are opportunities out there, more distressed opportunities as well. We can be a bit more picky around pricing, given that it's increasingly a buyer's market as well. And well, yeah, our investment committee is well aware of that and has raised its expectation in that regard. And yes, we are being more return focused.
Just to pick up on this, I mean, throughout the conferences, you hear a lot about people complaining about the lack of quality assets being put on the market. I mean, from our perspective, what we saw as well is the lack of quality buyers at the same time. It's a lot of the time, the people who tend to invest are basically not as I wouldn't use the word professional, but this is not their main area of focus. So there is a lot of education to be done. There is a lot of investment time which tend to drag the acquisition or the development process of any opportunity.
Great, thanks. And on, Alex, just talking about the debt piece quickly. Debt markets have probably changed somewhat in the last 18 to 24 months. In part because of the global picture, in part because of some of the currency instability and challenges we've seen in the region. How are you finding getting access to decent leveraging on your assets?
It's a very good point. Yeah, getting leverage on assets has been increasingly difficult over the last 12 to 18 months. I think that's accurate, and that is across the board for whether it's greenfield, brownfield, or existing. The assets that are the easiest to leverage these days are clearly the trophy kind of stabilized assets that are that are well operated, efficiently ran, producing high levels of GDP and EBITDA, and that would offer a comfortable ICR or DSCR to the lenders. So that's kind of for the existing assets. For the development and brownfield assets, well, we are for the Intercon Lusaka, for example. Well, we've bought that full equity, and we'll be probably looking to put some leverage into it, like potentially through doing a refi of the acquisition or doing a financing through debt financing of the refurbishment. So those are things that we're kind of learning to deal with as well. One of the earlier assets that we looked at for quite some time, that was beginning of last year, that was in Nigeria. Well, the deal has been stalled on the back of lack of development financing. We had several banks lined up. one of them basically dropped out because of the restriction on USD denominated loans. So no, it has shape in our strategy, and this is one of the components that we have to evolve with.
Okay. Alexis, you're a former banker. Maybe you can comment a bit on where you think the debt capital markets liquidity is sitting. Whether there's access to debt out there, and whether it's improving or deteriorating.
Very, very, very good subject, and I'm sure that's a subject that interests a lot of people because, we all know that a hotel investment project only makes sense if you are able to leverage it. That's how you make your return, and for that you need long-term funding. It's nearly impossible to pay back your debt in 4 or 5 years with a decent leverage on the hotel project. That's a clear issue because, it's hard to speak of Africa in general because some markets are very different. For example, Kenya is quite liquid. Some other markets will be less liquid, but in general, there is a lack within commercial banks of long-term funds available to back projects. Either the quantum is not there. If you're looking at a $50 million or euros deal and you need 30 million of debt, it's often tough actually to find this liquidity within one bank. It's expensive because most of African banks actually have a very high funding cost. So ultimately, you're going to end up paying $7, $8, $9, $10 on the US dollar loan when LIBOR rates are, I don't know today, but like between 0 and 1%. So it's definitely a challenge. And coming back to actually the point of Alexandre, I think that today you cannot make an investment in Africa in a hotel without a real investment angle. You cannot do a pure investment relying on leverage, relying on growth. You need to come with a real investment thesis, rebranding, repositioning, something like that. Just because the debt actually is not a tool to make your return. It's actually more. It's actually more a break to making your investment. So I come from the DFI world. That's actually the role of DFI, and that's why actually they have a lot of opportunities in Africa, is actually to bring this extra liquidity that is not existing in the market. The reality is that, and now I can say it because I've moved to the other side of the table. The reality is that yes, DFIs do bring the necessary liquidity. However, they don't bring competition to the market, and I'm sure that you've all noticed that. And secondly, they're very long in assessing projects and being capable of delivering. So,
okay,
it's tough.
So, and kind of coming back to the flexibility that we talked about, sometimes you need to come in, if you can, full equity, do a refi, and get the numbers up that way. We've got a couple minutes left, so perhaps we can just open up the floor to maybe 2 questions before we round off, if we have some out there. There we go.
Hello. So my question is, when investing in hospitality in Africa, are you guys targeting like Western tourists? And my question is coming just because from my analysis, most of like 5-star or 4-star hotels in Africa do not really reflect what Africa has to offer, culturally. For instance, last year I was here during Christmas, and what I noticed is there was a hotel locally here in Lomé that was exposing like things about Christmas. And that's one of my questions. The second one is, given the reality of climate change today, do you guys take into consideration that really hot topic before investing in hotel industry in Africa? So those are my 2 questions.
So just to understand the first question, it's do you take into consideration when you look at investments what your target market
What is the target market?
Okay, okay.
Is it Western tourists coming to Africa or like local Africans, you know, traveling in between the countries?
I suspect the answer to that will be, you know, it very much depends on what market you're in, what segment you're in, and you know, who ultimately your corporate client base is. Alex, is there anything you want to comment on there?
Yeah, sure. So, well, as mentioned initially, we target business clientele, generally speaking. We don't look into the leisure market too much. KHIR, so maybe they can explain why they would look into that market. Yeah, we like kind of business destinations because, you know, it brings more of a recurring pattern versus, you know, leisure tourism that can be more cyclical. So, you know, that we think that, you know, creates the foundation and, you know, a solid bedrock for minimum income. Another point, and, you know, Alexis was talking about it, is the mid-market. We see very big potential for the mid-market segment in sub-Saharan Africa. We know the growth of the middle class and, you know, developing business. So those are things. Those are kind of elements that we're targeting, that we're targeting right now.
Great. And a second question on that, Othman, maybe you can answer, but on you have both developed and invested. The question of greening, you know, climate change, how does that play into the investment equation?
Well, Kingdom has been focused on both the leisure market and the segment, on the business segment. If we were, I mean, in today's time, we're not looking at investing anymore. However, if we were looking at deploying capital, we would only be focusing on the business segment. We wouldn't touch any of the resorts or of the resort bit. The reason why we're looking at Africa basically is there are opportunities. We see that there are clearly opportunities. We just have to be more long-term viewer than short-term. I mean, we've been here for about 10, 15 years, and it was about time for us to start divesting. We basically did our job in the sense that we built the infrastructure. We perceive the hotel as infrastructure rather just than a business. Africa and both investors and lenders need to perceive that as an infrastructure tool rather than just something you build to attract customers. So does that respond to your question?
Yeah, I think that addressed the question. We're out of time, but I'm sure you can still ask our panelists some questions after. So we just had half an hour to go. Please join me in welcoming and thanking Othman, Alex and Alexis for their insights. Very interesting. I think, you know, certainly one of the takeaways is that when you are investing, it's not easy out there. You know, you got to work hard on your entry. You got to work hard on your exit. And I think, as Alexis said, you know, often you need to work the assets. You need to come in with a real investment angle and seeing where you can get that upside to make your investment return. So, thank you very much, gentlemen.